The two basic types of retirement income are pensions and annuities. These terms are often used interchangeably, and so they've somewhat lost their distinction. However, for tax purposes, the treatment is very similar. The general rule is that if the pension or annuity is funded by the employer, the retirement income is fully taxable. If the annuity plan is funded by the employee, then the payments received are not taxable. If the plan is funded by both the employer and employee, then the income is partially taxable. The general definition for a pension is a series of regularly scheduled payments over a defined period paid by former employers to employees that are now retired. In short, it's the company's plan. These are retirement tools used by larger companies that want to retain control of the retirement program funds. Since pension funds are almost always fully funded by the employer, then retirement income is almost always taxable to the retired recipient. Likewise, because the employer is funding the program, the plan can vary substantially from company to company. Nonetheless, they all have some type of a formula. For example, the plan may state that the recipient be at least 55 years of age and employed with the company for 25 years in order to benefit from the plan. Whatever the requirements are, once a taxpayer meets those qualifications, they are eligible to draw their retirement. Annuities are also a series of payments made to the retired employee, but insurance companies generally make them because they are the ones that fund the annuities. Either they are fixed or variable. In other words, the taxpayer can receive an equal amount every month or establish varying payments. Most retired taxpayers choose a fixed amount. The taxpayer can buy the contract from an insurance company or buy it through his or her employer. For tax purposes, there are two types of pension and annuity plans: qualified and unqualified. Qualified employee plan is a pension or annuity that meets specific requirements dictated by the IRS. Because it meets these requirements, it gets special tax treatment for the taxpayer. If the retirement plan is not qualified, then these beneficial tax treatments don't apply. For this reason, most plans are qualified by the employer or insurance company when they are created. Unless told otherwise, you may assume that any income from a pension came from a qualified plan. As I mentioned a moment ago, if the employer paid all the payments for the cost of a pension or annuity, the amount of the pension or annuity is taxable. This is the most common situation. However, if the taxpayer contributed after-tax dollars to his or her pension plan prior to retiring, only part of the distribution is taxable. To determine the tax treatment of the pension and annuity income from these plans, you will use one of two methods: the general rule or the simplified method, with the latter being the most common. Let me just say, in most cases, all this has been worked out by the paying agency, and the taxable amount of the distributions will be obvious. However, just in case, you should refer to the simplified method worksheet in your book. It will lead you systematically through the process of determining the taxable portion of the distribution. Many companies, particularly small employers, may not have the ability to set up a pension or annuity, so they may choose to go another route, either a SEP program or a simple retirement plan. We'll discuss those later in this module.